First rates Monday morning after a two-day holiday. Well, the mood clearly is upbeat. 90 points higher for the Nifty, 273 points up for the Sensex, 0.5% higher for the Bank Nifty. All benchmark indices, they are off to a good start now. Yes Bank, SBI may not be looking at selling their stake immediately, but the stock's fallen because of the fear of supply. It's at 16.5. In terms of volume, you've got Nalco, where the volumes are at 1.4 million shares first thing this Monday morning. GAIL, Suzlon Energy, that's all moving higher. Pointless to say that where Adani group of stocks are because they would be racing higher. Adani Green, Adani Enterprises, Adani Port, Ambuja, all of them will be racing higher. There is a spring in the stride for some of the fintech stocks because Zomato is up 2%. There is an uptick which is now there in Paytm. There is uptick which is now there even in Policy Bazaar. Where is Nykaa? I think there's a report in Nykaa from Macquarie which talks about increasing competition and intensified competition could have impact on the underlying business per se of Nykaa. And for a haloed stock now, it's coming under pressure. 146 rupees. Nothing in terms of a large block deal, if I can say so, but it's the Adani group of stocks where the party continues. Aisha?
Yeah, absolutely. They are the ones which are riding high and they continue to do so. So pick up any stock, be it Adani Enterprises, Ports, Ambuja, they're all holding up very, very smartly. Vedanta as well, after the management clarifying all the news around and surrounding that particular company, Vedanta as well, held out on Friday, and today as well it's seeing about 1.25% kind of gain right now on the screens. Couple of other stocks which are in focus, and we just told you about Power Grid, which is one bid for 2 projects in the state of Chhattisgarh. Look out for that. HAL, which has got an IT refund of about 700 odd crore rupees. So that as well is another stock which is in focus. We highlighted earlier today that MGL has acquired Unison Enviro for 531 crore rupees in cash. MGL gaps up about almost 3% in trade as we speak right now. And then Bajaj Electricals as well, which has got a sizable 565 crore rupees order. That also is another stock in focus. Gaps up about almost 3.5%, more than that actually right now in trade as we speak. There's IEX as well, and the February total volumes have come in lower, 7% on a month-on-month basis and 6% on a year-on-year basis. That as well is down about 0.5% as we speak. But besides that, it's a pretty okay market, Kunal.
I think so. Okay market. Bank Nifty is opened up with 260 points up, so 41,500 on the spot levels. Nifty is back again at that 17,750 mark. So I think from a short-term intraday perspective, the trade which I'm taking right now is to try and book out profits on the Bank Nifty, the ones which we initiated specifically on Friday morning. So I think it's a good time, 1,000 plus points on the Bank Nifty, and I think from a short-term trader, the index would now come back into a slight overbought territory. So now trying to probably shuffle from the Bank Nifty to some other sectors.
Right. Okay. Nooresh, what about the first trades that you're executing and punching in right now? Nooresh, I think your mic's mute.
Yeah. Buying on Tata Power, the stock seems to be on verge of a breakout about the 210-12 mark. Once that happens, it could be a quick move. So preempting a buy over there.
Okay, and as promised, it's the mega exclusive. The man behind the 15,000 crore rupee investment in the Adani Group shares with us his rationale on why he's betting big on the India infrastructure story. In fact, he remains optimistic about the India story. He says its capex push is at par with China's, adds that he's staying away from Indian IT services, but likes stocks like SBI as well as NTPC.
We have followed this group for a while, and we had never done anything because as infrastructure has been a tough space. In general, we've been underweight infra. In fact, we barely owned anything in infra for the longest time. But I think the recent events kind of made it very, very attractive in general. And the other aspect is that the group itself, from a fundamental bottom-up perspective, is better positioned. If you look at Adani Enterprises, for example, them getting Mumbai Airport 2.5 years ago, that was a kind of game changer, but the stock ran away. If you look at the Adani ports and their foray into the more sort of hinterland as such, it could make it very powerful. So I think every name had its own unique entity, elements which made it very attractive. And we, as you know, we have significant investments on the utility type businesses. In fact, if I look at it globally outside of India, we have almost $5 billion invested in utility type assets, pipeline, airports. So we do understand those businesses. And I thought there was a kind of a mismatch between how people look at classic PE type stuff, which is not really is not really that sort of relevant in the stage these companies are. So that was kind of the genesis of how we thought about these, the whole group.
Well, allow me to take the clock back. The sell-off in Adani Group of stocks. What, to your mind, led to the sell-off in Adani Group of stocks, and what gives you the commitment that despite the erosion in the equity value, the group is in fine fettle?
So as you know, the starting point, I mean, the stock, first of all, did run up quite aggressive last year and a half, 2 years. And some of them was Adani Green that ran up along with the other similar names in Europe and other places. So, there was a big influx of ESG money, whether index or active, into these kind of names. And that obviously, made some of these stocks kind of, a bit expensive versus their own history. And then this short sale report came out, which obviously was very strongly worded in my opinion. Although as we started peeling the onion, we thought that this was kind of old rehashed story, and from our perspective, the substance was not as meaningful here. But that sort of triggered this leg, which took it down. And I think the other part is that the technicalities of the index players involved, so and so, kind of made it worse.
Right. The fact that Adani Group of stocks by traditional yardstick are expensive and that debt levels are high, as a fund manager, as an investor, what gives you the conviction that both the concerns which historically have been big concerns for Adani Group of stocks, those concerns, according to you in your playbook, is something which is manageable?
See, if you look at vast majority of the assets are regulated assets. They tend to a very, very long tail. So when you can't have financial leverage along with operating leverage. These companies have very sort of predictable long-term trajectory, even if you slow down the growth. So that's the first part of it. And when you adjust for the leverage, in fact, if you look at the U.S. utilities, and we own a bunch of them, on an average debt to EBITDA levels in U.S. utilities, and these are some of the best of the breed, is around 6 to 7 times debt to EBITDA. If you look at the leverage here, it's around 3.5 times. But the growth capex is why the negative free cash flow kicks in. So I think they have predictable earning stream that has 20 plus year visibility. These are regulated assets, and in growth utilities they tend to have negative free cash flow. That's the norm. That's, in fact, you want to have them. You want to have them have negative free cash flow. That means because they're able to deploy capital on a longer term basis with fairly attractive returns. So the debt levels, when you look from a utility perspective, is actually on the lower side, not on the higher side. But if they lower the capex plans, which they already announced, I think it becomes a fairly attractive sort of risk reward.
The fact that Adani Enterprises FPO did not go through, that means the proposed capital in the company will not come in, and that will have impact on the growth plan. Are you conscious of that?
No, of course we are, and I think that again is a growth capex issue rather than maintenance capex, because a lot of these businesses don't have a lot of maintenance capex. So I think from that perspective, we feel it's perfectly fine. They just have to tune down the growth rates, but it becomes a lot more stable and hence arguably a higher valuation.
Rajiv Jain has always maintained that the way he invests is that good news and good prices never come together, and he never wastes a crisis. So is this some kind of a crisis where you are investing the classic Rajiv Jain way, never waste a crisis?
Yeah, look, Nikunj, I mean, I think that's an important part of what we do, because if you think about investing, it's nothing but an arbitrage between perception and reality. If there's a perfect company, so chances are the prices would be so expensive that it actually becomes an imperfect stock. I'll give you a couple of examples. I mean, I remember first time when we bought ITC in a meaningful way was 1996, when there was a tax liability risk on them, and the stock declined. I believe this was early 1996, but almost 35% plus. And as you know, we own ITC. We ended up owning ITC for over 2 decades. I believe almost 21 years. Then if I go back to actually 2004 elections, we bought significantly during the election. The markets are almost 25-30% in matter of days. And then the last one would be the sanctions, U.S. sanctions against India in 1998. And the market is down almost 35-40% matter of 6-7 months. In fact, but I will also tell you, I'm telling you some of the winners. So to be fair, I have to tell you one of the losers, which was I got very nervous in early 17 after the demonetization, which obviously was a huge mistake. So in general, if you buy fundamentally sound businesses with very high barriers to entry, because think about it, you cannot replicate Mumbai Airport. Can you predict earnings growth of Microsoft, which is a fantastic franchise, 12 months out? They've gone from 20% revenue growth to 5-6% revenue growth. That is, in other words, compared to Mumbai Airport, it's actually much more predictable long-term story. The question is, you got to buy it cheap enough.
So why did you shy away from buying Adani Group of stocks earlier? They still had the airport, they still had the infrastructure projects in place, and they did not have any kind of concerns which a lot of analysts have raised about high valuations and high leverage. What stopped you from buying them in 2020, 21, or even 22?
Yeah, so I think if you look at the ports, for example, the regulatory changes have been much more recent, by the way. So I think the fundamentals of business today are better in the last 2 years than they were before at the margin. Number two is, look, we deploy a lot of capital. You can't simply start chasing because you can't execute in 2 days or something. When you talk about hundreds of millions of dollars, I mean, $500 million kind of stuff, we would move the price. So we do need some sort of a shakeout for us to enter. And these things had such a strong momentum, and the valuations were getting extended, so we couldn't have executed them in a sort of proper manner versus, let's say, in my opinion, a mini crisis like what we're seeing now.
What is your view on the debt market reaction to Adani Group of companies? There is a royal in the bond market as well. So do you think apart from equity market, the bond market also has overreacted?
In fact, it's interesting because if you look at the bond markets, they initially reacted, but I mean, they're down to sort of low teens to a high single, depending. I think transmission, I believe, is 9% and green is around 13-14%. And green, as you know, is one of the more leveraged ones. So I think they behave reasonably well. And I do believe that if the stock price reacts favorably, those will also come in. So globally, interest rates have gone up everywhere in the world. Right. So when you look at the spreads have not widened as much. I mean, they did for a brief moment, but they're sort of calmed down. Almost all the rating agencies have reaffirmed. So in fact, the bond markets are kind of telling you the same story that this is not a crisis situation from an underlying fundamental business perspective. Yes, the growth will be slightly slower than what you would have had without that, but I think that makes it more stable and hence a lot more defensive.
So what to your mind could be the growth for Adani Group of companies? And when you're penciling in an investment, I'm sure you must have looked at a terminal rate, like you said, that investing is about buying gold at the price of silver.
Yeah, so I think if you look at depending company by company, green probably has the sort of faster growth rate here, but it's also the most leveraged and so on and so forth. But I think on an average, I would say mid-teen is very, very doable, if not a little bit higher. And if you think about across India, there are not too many businesses which can deliver at sensible valuations, because if they slow down sort of growth capex, the free cash flow will come in pretty quickly. So I think you're looking at mid-teen plus kind of growth rates.
A lot of global investors, and you just refer to that, ESG concerns. Do you think this investment of yours, in a sense, gets that ESG endorsement as well? Because that's one concern which, again, has been raised of late by global investors and by global rating agencies.
Well, I think if I ran my portfolio based on what rating agencies tell me, I'll be a bum on the street. Okay, so I couldn't care less what they say. In fact, I believe but if the indices taken out from index, I'll be happy camper, because I think it'll just allow us to increase position if we need to. So I think a lot of these are kind of mechanical box checking exercises, which really don't mean anything. I mean, so I'll tell you an example. I mean, Reliance, we first started buying in a big way in this cycle in 2016, late 2016 and early 2017. They had not rolled out the geo at that point, right? And I think similar concerns and were there for those two. So look, I mean, this is what I'm saying. There has to be some reason for pessimism. I mean, otherwise there wouldn't be any pessimism. But I think I'm actually perfectly happy for the rating agencies to take these stocks out of the index or what have you. I mean, it'll be a good thing, not a bad thing, for us.
It's a rarity for us to get you on television, and every time Rajiv Jain is on television, he's supposed to make a big prediction. So let me just change gears and talk about what is your outlook on equity market. Post 2020, interest rates came down, interest rates are now going higher. Buffett always says that interest rates are like gravity, they put valuations down. So in this rising interest rate environment, what do you think one should expect from equity markets, especially global equity markets?
Yes, so global equity markets, I feel one has to be a little bit more cautious because interest rates have not fully, they've gone up quite a bit. But if inflation doesn't come down in a meaningful manner, then there's a possibility interest rates can still surprise on the upside. In fact, if you look at the consensus expectations on US interest rates, they have moved since February, by the way, almost 65, 70 basis points in terms of where interest rates could end up by end of this year. So I think there's still some risk. The other part is, by the way, the geopolitical risk on a higher side. So I think we have to incorporate that, which, by the way, is another reason I actually like India, because it has less geopolitical risk. So the risk factors are a lot more favorable in India than most of the other places. If you look at the constant barrage of news coming out of Washington, D.C. against China in terms of sanction against companies, products, and so on and so forth, that is not a recipe for re-rating for China per se. So in general, I believe that the market return expectations should be on the lower side, not a higher side, because there's been a whole generation of investors who have basically seen nothing but low or declining rates, and that I think that movie is pretty much over.
In general, the view on India is that Indian economy is in a fine fettle, and we are very proud that we are one of the fastest growing economy in the world. Stability, I think, is something which is obvious, both in terms of the corporate predictability and the political stability, something you refer to. But my question is that everybody has also raised concerns about valuations in India. The reverse of what I asked you. It's like saying that in India, the market is great, but you're buying gold at the price of diamond.
Yeah, look, I think valuation is always an approximation, first of all. So, but I think part of the India's issue is the index composition, and I'm not saying in a bad way, but just a fact. So if you look at, for example, state-owned banks in India, well, they're selling similar values to state-owned banks in China. Look at energy companies in India, same in China. Tech companies, very similar in China. But the index composition in China is a lot more cyclical versus index composition in India, right? So if you look at pharma companies in China, they're actually a little bit more expensive. Some of the best staples in China are similar valuations in India. So I think when you adjust for that, the valuation gap is not really much different. Not to mention, if recently companies like Baba and Tencent, the government has taken golden share, right? Which basically means that, in my opinion, they are quasi-state-owned. The problem is the state-owned companies in China trade at 5 times earnings, but these private sector companies, which in my opinion are trending towards becoming state-owned, they're 25 to 30 times earnings. So when you adjust for all of that, I mean, I think the valuations are fairly reasonable.
Would you be looking at increasing your India exposure since you're a global fund now and you got the options to invest in other countries as well?
Look, I mean, we try not to make these predictions whether we're going to increase or not. It's a very bottom-up story. I mean, so for example, if let's say the Adani Group hadn't faced the issue that they're facing now, in my opinion, these are very short-term issues. I don't think we'll be discussing 3-5 years. We probably wouldn't have bought those, right? So I think it's bottom-up stock specific, but in general, our India exposure is been trending higher, not lower.
But can I safely assume that when you've invested in Adani Group of companies and the way you've invested in the past, this is not like a trading bet, this is not like a tactical investment, this is more like a trade if all goes well, or investment rather, not trade, I beg your pardon. It's an investment which could be a multi-year investment?
Yeah, look, I mean, these are businesses which we really have. In fact, we tend to take 5% every business. We would not own a business if you're not sure how the business looks like 5 years. So I think this could be a very, very long-term trade.
Given
In
that,
fact, I mean, if you look at the HDFC banks, I think we've owned it for almost 20 plus years. Housing Development Finance Corporation, I've been owned for 24 years. So a lot of these names we owned for a very, very long time. And by the way, HDFC Bank in 2001 and 2 wasn't exactly as popular as seems to be in the last few years.
there is an election cycle in 2024. As a global investor, how conscious are you of that?
I don't think so. I've actually sold or bought stocks simply, before elections, because I think there's more fear than a substantive change that happens because of elections. Because I think there are a lot of self-driven momentum that you're seeing in various states. That the policy, the reforms that have happened last 5-6 years are quite dramatic, and I think sometimes I feel they don't get enough day in the sun, which means that the growth might be a lot more self-sustaining for the foreseeable future. I'm not saying for 20 years, but in the foreseeable future. So I don't believe it'll change much at all. In fact, as I said, sometimes again there's a mini crisis because of elections, because people always get either too excited, too depressed because of who's running. But I think over the last 5-6 years, the changes that have taken place, the reforms that have taken place from almost every sector, there's sort of a self-driven element of a lot of these which will help the earnings growth.
If I just talk about your current holdings, the India romance, some would argue, is centered around IT, consumers, and financials. But you have little exposure to consumer staples and IT. Why is that?
Look, there's nothing wrong with them, but in my opinion, there's just better opportunities. So if you look at staples, I mean, ITC last year when we started buying in a bigger way was 14-15 times earnings with a 5% dividend deal, right? And thanks to the ESG, so I have to give them credit that we made some decent money. So we always have to thank somebody for the opportunity to get in. But we really don't own any other staples. I mean, they're fine, but Hindustan Unilever is not exactly being given away at, 55 times earnings. So those are comfortable names to own. And the problem with comfortable names is that it's hard to really beat, the averages with those comfort names. In fact, if you look at the portfolio construction today, it looks very different than what I've had in the last 15 plus years. As you know, I don't know, it's close to 30 years that I've been investing in India professionally. So there's a big infrastructure thrust. There's a big thrust on some of the state-owned companies. I think we actually like NTPC a lot, as an example. We don't own IT services because they would be more cyclical than what people think. They're fantastic companies, by the way. So if I didn't own anything else, if I'm running an India fund, I probably would own them. But we like to run it very concentrated. So they just don't fit the bill. When you add everything up, there are just better opportunities elsewhere.
There is NTPC, there is State Bank of India, there is NTPC in your portfolio. The common tag here is these are PSU banks. These are PSU owned. These are government owned companies. And historically, global investors, at least who've invested in India, even the folks who've been investing for more than 2 decades now, they've not bought PSUs. You are buying them. You've invested in them. Why is that?
Well, I think it takes two to tango, right? So for every buyer, there's a seller. So, but I think the first of all, I disagree with something you said. If you were sitting here in 2005, SBI used to trade at 15-20% premium for foreigners. Foreigners couldn't buy at the market, by the way, right? So like everything else in markets, that is the sentiment is cyclical, and I think in our opinion it'll change. But the good news is the way we think about it is that our job is to get earnings growth and the dividend combination right. If the valuations increase, that's wonderful. But even if they don't increase, we should be able to compound at double digits. That's how we think about it. So we don't wait and hope for others to agree with our view. Maybe they never agree. But in the meantime, the earnings growth plus dividend gets us to double digits. We are happy owners.
You've always insisted that market price is a function of EPS into PE. PE is perception, EPS is growth. In Indian market, where do you think there is scope for PE expansion as well as EPS expansion? And where do you think there is scope of only EPS expansion and no PE expansion?
Yeah, I think the second bucket, you'll get the companies like Nestle's of this world. I think these companies will continue to deliver, but Nestle, I don't know, 70, 75 times, something like that earnings. I've kind of lost track. And Nestle, as you know, was a large position for a long time. Could they be derated as the earnings growth shifts away to other areas? Because you have to look at one aspect. Over the last decade or so, globally, earnings growth was on a slower side. So a lot of these defensive type businesses were re-rated because investors look for growth, including us, right? So growth was scarce. Now, and interest rates were low. So you got a bubble in tech, not so much in India, but elsewhere. On the first bucket, look, I think we talked about some of those. I mean, State Bank of India, why does they have to sell at 8 times earnings? Because I think they'll grow at mid-teens plus earnings. So could they deliver those returns? If they keep delivering those returns, could the multiples be higher? I think so. In fact, even some of the private sector banks have recently been derated too. So in fact, I would argue that most of the names that we own have a reasonable chance of multiple expansion. But if it doesn't happen, it's not the end of the world.
What makes you so bullish on State Bank of India? I've spoken about State Bank of India at least 4 or 5 times in this conversation. Are you not worried about, and again, I'm being a devil's advocate here. My personal view on State Bank of India is very bullish, but here I'm asking a question as a commentator that their return ratios are not the best in the industry. Their ROA is just about 1%. Private banks in India pretty much have better return ratios than SBI.
Mm-hmm.
So what makes you so bullish?
I think if you look at the corporate side, besides ICICI, I think they're probably one of the better positions on the corporate book. But I think the question always is what is discounted in the price. So yes, I agree the return ratio is not as good, but who would be able to grow earnings at mid-teens plus in a much more consistent manner, and what the market is not anticipating? I think that's where we believe the rubber meets the road in terms of the gap between what I say perception and reality. So at 8 times earnings, if you take a 5-year view and they grow earnings at, let's say, mid-teens plus, it becomes a fairly attractive proposition. Especially because they have a much better. I mean, there are a lot of private sector banks who have really no experience in lending to the corporates, by the way. But that was a strength for them. But could that become a weakness going forward?
Have you had a look at the Indian internet and consumer tech companies which have gone public? There's a Paytm, there is a Nykaa, there is a Zomato. These are exciting businesses. These are businesses which some would say are the future high-growth businesses of this decade.
Yeah, look, we look at a lot of things, and we looked at some of the US and the European ones too, and if you look at the profitability expectations that these companies had, they are being cut pretty aggressively. And the reason is some of these businesses have really no barriers to entry. So the growth is fine, but is this sustainable long-term growth? And one of the things we look for all the time is, what are the barriers to entry? Can somebody else replicate those businesses? And at this point, there's no evidence that these are truly businesses that have any pricing power or sort of barriers which can make it difficult for others to come in. So the valuations are still on expensive side for what they're delivering. But I mean, I'm not saying people can't make money. As they say, there are 100 ways to heaven. You just need to find one. But from our cup of tea, they're just better fishes to fry in some of the other areas.
Mr. Jain, every market follows a cycle, and there's always a theme which is at play. So in 2000, it was TMT. Then it was infra between 2003 and 2008. Then good old consumer stocks, which you bought aggressively, the HULs and the Nestles of the world. Can I say that looking at your portfolio positioning in India, you are betting on the infrastructure boom for next 3 to 5 years?
Look, I think we are pretty bullish on that, because I think there are a lot of things in place, because the execution under this administration has been strong, which is important here. And the second part is that we saw the similar in China in that stage of development where the infra spend actually took off in a big way almost 24, 25 years ago. So we feel that India might be in a similar sort of setup where the earnings growth could accelerate. The problem is there are only few and far names in the infra side, right? Quality names, they're not dime a dozen. Like banks, there are a lot of names you can play. If you look at consumer staples, there are a lot of names, but infra side there's a little bit dearth of those. I mean.
Back with the market right here in 80 now. Let's just revisit what the market has settled in at. It's a surely positive start to this truncated week. We're holding up almost 1% higher actually. 17,800 is back on the Nifty futures. Nifty Bank powering ahead by 1% as we speak right now. It's the Adani group of names which are actually leading from the front. Adani Enterprises is now up a solid 10%. Adani Ports up 5.5%. Ambuja as well looking very smart. There's Motherson, MGL, all news-based stocks which are holding up very, very smartly as we speak. Bajaj Finance, Infosys, HDFC Bank, all of these are the ones which are holding up and supporting the index as we speak right now. On that note, let's welcome on board Manish Santhalia and find out what he's making of the current market. Manish, hi, morning. Great to have you on the show as always. Manish, you think all that uncertainty and the negative overhang of the Adani saga is now behind us, you think?
I mean, a lot of negative news flows have already got priced in. Whether the worst has been seen or not remains to be seen. But stocks have actually seen a lot of correction. So we'll just wait and watch and see how the whole situation unfolds. So not too much of a call on the Adani group per se is how we'll look at it.
Did you buy in the Adani group of stocks when they fell?
No, we find the valuations a bit iffy, and so we have let go and we have given it a pass.
What has been your portfolio strategy this year? Did you lock some gains in banks? Did you revisited IT? What basically has kept you busy this year?
So I think we are focused on where the earnings growth has been, and I think the earnings growth for India has been coming from three major sectors. It has been the IT names, it has been your banks per se, and it has been automobiles. And what has actually been a detractor to earnings has been oil and gas and metals. So I think the focus is to tilt the portfolio towards an overweight position on these three sectors majorly. And added to that, we think as a contra play, pharma would have seen its worst, and because of a high base of 2020 and 21, you should see decent earnings growth going forward, particularly in Indian pharma company, not so much on the US generic export front, where we still see price erosion. And at the same time, I think capex, particularly government capex, is coming, and private capex should also build it, particularly on the defense, the railways. These sort of areas is where these sectors would remain excited. For us, we think that order book and execution would come through for them.
Manufacturing and capex revival, but some would say that is yesterday's story and yesterday's trend because these stocks have a run up and BP multiples are expensive, whether it's Siemens or ABB.
So, multiples are a function of how the earnings growth trajectory is going to look like, and markets will discount future earnings currently. If the multiples have gone up, I would believe they have not gone up so much that they would have factored in all of the earnings growth that's likely to come through for them for the next 3 or 5 years. So I think the story still remains intact in spite of the fact that market has taken a realization this is one of the areas which will be in the limelight for the next many years to come. And so I think a tab on the earnings growth per se for the capex will be seen. Particularly on the order book and the execution, and the story is yet to play.
Manish, last 18 months markets have given no returns, while the SIPs are strong, touch wood. PMS schemes have also struggled because markets have not gone anywhere. Do you think that could be the talking point for next couple of quarters, couple of weeks now, that investors are now going to be thinking hard that should they stick to a SIP or move to fixed income? Should they stay with a PMS or go to a fixed deposit?
So one thing which has surely changed in the last 1 year or so is the coming back of the fixed income asset class. Particularly when we were in a benign liquidity position, we were in a zero interest rate sort of a regime or very low interest rate sort of a regime. Everybody was focused on either real estate or equities or gold to some extent because there was a lot of uncertainty. But now, with interest rates rising, portion of asset class allocation would move towards fixed income. There's no taking away from that fact. And given the fact that India has basically outperformed many other emerging markets, the returns have been particularly strong over the last 1.5, 2 years. Earnings growth, we start every year with 20% and then it gets boiled down to 12, 13%. It makes a case for somewhat of a sideways market with an upward bias, definitely. Because once the entire interest rate hike gets priced in, you'll start to see markets also respond very strongly. So from that point of view, I would believe that yes, flows, particularly the new money coming to equities, is finding the tough justification from the equity markets near-term return point of view, but long-term trajectory is particularly good. And experienced investors who understand equity markets, have been in equity markets for long periods of time, would know that there could be periods of time correction, but ultimately this is one asset class which gives decent return over the period.
Right. Manish, just wondering that, much like Adani names, and of course, this is not any apple to apple comparison by any means, but the new age tech stocks as well have, gone through that cycle of perhaps bottoming out, and now the news flow is turning better. Wanted to understand how you're approaching the likes of Nykaa, Paytm, PB Fintech, Zomato, etc.
Some of these names will actually become very big. And given the fact that a lot of them have seen more than 50% sort of a correction, I would believe, and particularly so if you look at our portfolio, we like Paytm as well as Zomato. We think that this habit formation of food delivery is irreversible as far as India is concerned. It's similar to, consumer companies. You get into that habit formation, you like the product, and then it becomes a way of life. So I think when the IPOs came for these companies, it was all about total addressable market, the TAM. Currently, we are going through a phase of the path to profitability. What is the contribution margin? When will the EBITDA be turning positive? So on and so forth. And by the way, these companies today are focusing more on profitability than growth. So you would see that the food delivery business, both Swiggy and Zomato, actually saw some muted growth, but very good contribution margins. And they're on their way to achieve, let's say, 5% EBITDA margins on the food delivery business in some time. So I think ultimately markets will value absolute profits. And, that is how valuations would be derived. At 50,000 crores market cap for a Zomato, I would believe with 10,000 crores plus of cash in their books, yielding at least 500 crores of other income, the platform has value at that 40,000 crore mark. And I think one got to build in whether 70 crore orders annualized currently would translate into 150 crore orders, let's say 3 years down the line, a 20-25% CAGR growth rate in the number of orders, thanks to a habit formation. And by the way, China delivers some 1,200 crore orders every year. Similar is the case with, let's say, a Paytm, the distribution, business, loan distribution and financial services business is going great guns. Payments business, because of government subvention, is yielding them good money, and EBITDA losses are coming down. So there's no one size fit all for the entire new age tech companies, but there's definite value and in some of them, and some of them will not only survive but grow and thrive and create a lot of.
Hi, morning. What's the outlook when it comes to the entire metal space? Do you think that this could be the pullback year for the metal sector?
No, I don't think so, because if you look at, metals is primarily driven by China, and you saw the projection on China's GDP growth for next year, the current year, and at 5%, it was below expectation. So I think metals, on the contrary, could correct very sharply. And, the world is battling recessionary trends. So from that point of view, I think metals will be in a bearish trend.
There is a lot of chatter that banks have had their best run up, which is now deposit growth is lacking credit growth. NIMs are not likely to expand. While the sector will do well, the Q3 performance is unlikely. and best of the sector in terms of outperformance is behind us?
No, you are right. The hyper growth in profits that we have seen over the last many quarters, particularly will last for probably one or two more quarters at best. You could see some margin expansion. After that, it's going to be credit growth only slowing down from because interest rates are moving up and cost of deposits, cost of fund is only going to go up, which will be a bearing on margins. And obviously, if you normalize credit cost, these Goldilocks sort of a scenario on credit cost is also not going to be there. So bottom line is that 15 to 20% sort of a growth for large private sector banks or even let's say State Bank of India is achievable. Now it comes down to valuation. There's nothing left on the table as far as the valuation, re-rating possibility is concerned. So what do we do in spite of the fact that absolute profit growth in the sector is here to stay and will only grow over a period of time? Markets would want to look forward to the second, apart from the large 4-5 banks that everybody is tuned on, it comes to the next round of stock, which is basically your PSU bank. BFSI as a space will remain in the limelight because of absolute profit growth. Of course, in percentage terms, it's going to be lesser than what we have seen in the last 4-5 quarters. But and so it comes down to valuations, and valuations are very full for the large names, and it would be broadly be boiling down to the second rung names, which is your PSU banks or let's say mid-cap banks. So that's how we would look at it.
All right, Manish, thank you for sharing with us your thoughts on the markets, individual sectors, as well as where you're seeing promise. A quick glance at the index, and as things stand, we're at 17,760 plus levels. Within the broader markets as well, there's quite a bit of traction picking up. And apart from the Adani Group stocks, you've got something like a Mahanagar Gas, 7%, BSC that's up 6.5%, Jindal Stainless, there's National Fertilizers that's perking up in trade, MRPL along with Ujjivan and Ircon International. Those are some of the buzzers in today's trade. Let's get a move on then. We've got P.N. Vasudevan, is the Managing Director and CEO at Equitas Small Finance Bank, joining in to talk a little bit more about the Universal Banking License, deposit growth outlook, as well as what the next step is post the Equitas merger. Thank you so much for taking time out. Now, given that the merger is done away with, what is going to be the next step and how quickly are you looking to obtain the Universal Banking License?
Good morning. So the merger was a requirement to be completed by us as per our licensing licensing conditions, because the promoter was supposed to dilute the stake to 40% at the end of 5 years. But our promoter, which is a holding company, was at 75% after 5 years. So the merger was a critical step that we had to complete from a compliance perspective. And thankfully now that's behind us. It's come done and dusted and behind us now. So we will be in touch with RBI, and whenever RBI permits us to apply for the universal bank license, then we shall be doing so. And the merger also has brought in an additional net worth of around 325 crores to the bank, which has helped the bank to take its capital adequacy to around 24%.
Okay, fair enough. And given the fact that, Mr. Vasudevan, your stock since the merger has gone up about 40%, do you think you were unfairly valued, or is it just the merger overhang is now complete?
Oh, I really have no idea how the market works. So I don't think I'll be able to answer that.
Just wanted to move away from that and talk about your credit growth guidance as well, 25%. And you're one of the few banks who managed to grow your deposits faster than your loans in Q3. Will your goal be to continue to grow deposits faster than credit?
Yeah, so we have guided a credit growth of around 25% plus for the year, and we were at 27% growth as of 9 months ended December. So I think we are fairly in line to clock that 25% plus for the full year by March. As far as deposits is concerned, yes, we have been able to grow deposits quite sharply over the last 2-3 years, and the trend has continued in the current year also. One of the things which has been helping us is our digital acquisition of savings accounts. The digital acquired savings accounts are contributing nearly 10% of the balances of our savings balances. So that's been a good contributor from a deposit accretion perspective. And our aim will be to try and continue to grow deposits at the same level as the credit growth or slightly higher if that's possible.
You know, the premier banker in this country came out and called the current period a Goldilocks period for banks. You focus a lot on MFI as well as smaller ticket loans. How is it that you believe, or rather, how long do you believe this will continue for your segment?
See, the small business loans, we had in our last quarterly presentation set out a few data points on the small business loan market. As per various government data, the demand for loans from the small business segment is nearly about 20 lakh crores, and hardly about 4% or 5% of that is serviced by the banks. So you're really looking at a demand which has not been serviced fully over the last so many decades by the banks. So that, given that scenario, I believe that a sustainable growth for banks like us, which are focused on the small borrowers, is very much possible over a fairly long period of time.
Okay. Also, you know, when we spoke in January of this year, you had suggested that your current account within CASA looked weak and that you were looking to focus on that, you know, given that you're focused on small business loans. Any change on that front?
Yeah, current account continues to remain a strong focus for us, and you know, it was low at around 4% of our CASA balance, and our effort is to try and increase it to at least some 7.5 to 8% in the medium term. And you know, the fact we have now rolled out a overdraft product for the small business customers, where there is a current account, you know, underlying, and the transactions flow through the current account. So we are really hoping that there will be some improvement in the current account balances because of these initiatives.
Okay. What's the risk of the loans that you're disbursing right now? Because I understand it is granular and small businesses which depend on it, but they are also the ones who will face problems first in case of a downturn.
Yeah. So actually, you know, the customers to whom we finance are the people who are selling daily use products and services. They are not really into industrial or consumer kind of thing or discretionary kind of spending products. They are into daily use products and services. So typically, you know, whatever happens to the broader economy, these people will continue to have a proper, I mean, a good business model at that level, because their products are really something that people have to use on a daily basis. The problem arises when we go for such dramatic status like lockdowns, which happen over the last 2 years. When the town is closed, our people can't open their shop and they can't make any money, then they're really out, down and out. And we had that scenario 2 years back, or over the last 2 years. But so long as we don't have that kind of dramatic, you know, events happening in the market, and if the thing is a little bit more normal, then our customers' business model is fairly resilient. And that is why, if you see the last 9 months, last 3 quarters, we have been able to quickly overcome the past effect of Corona and come back to a very strong, you know, ROA of over 2% in the December quarter.
All right, thank you so much for joining in and giving us a sense as to how business is shaping up. So their merger has been a critical step from the compliance perspective, and they are seeing a net credit growth of about 25% plus this year, and deposit growth as well. They have been able to grow that quite sharply. Let's get a move on and take a very quick break on this at this juncture. Come right back. We've got Chartbusters lined up, as well as lots more when we return.